Dividend investors, bonjour, this is Mike Yeroux, founder of Dividend Stocks Rocks and passionate investor. Welcome to my YouTube channel where I show you how to invest with more conviction so you can enjoy your retirement. Today we are talking about a strong pipeline, one of my favorite stock in the energy sector called TC Energy. The company trades on both markets, so Canadian and US, offer a generous yield, almost 6%, and most importantly, it has successfully increased its dividend since 2001, showing 20 consecutive years of dividend increase. There have been some very important news coming up last week as new administration Biden decided to say, you know what, we don't want Keystone XL project, which was a pipeline project for the oil and gas industry, led by TC Energy, and they said just no, it's not going to happen. It was expected. We're going to look in this video how it affected TRP, how it could benefit to other stocks actually, and first we are going to look at how DRP business model could be a good fit for your portfolio and if the dividend is safe moving forward. So let's start with the dividend triangle of TRP. So this is what I start all my investment research with. I want to look at revenue, earnings, and dividend growth over the past 5 years. On this graph, I've made an exception and I used funds from operation, mostly because it is a most important metric when you look at pipeline. It tells you a lot more than the revenue would tell you. What you see on this graph is if you have been a shareholder of TRP for the past 5 years, you haven't made much on the capital gain side, but you did receive some generous dividend. It kept increasing year after year, which is kind of interesting. Earnings per shares are following a very good trend, sorry. And when you look at the FFO, the funds from operation, what you see here is we have something that went high very fast and then started declining in 2020. Keep in mind, in 2020, what happened is the company received a tax credit in 2019, which boosted their funds from operation. Didn't happen in 2020. This explains the small decline here. So nothing to worry about the overall perspective. Now let's dig into their business model. So TRP business model is all about pipelines. We're talking about a company that is deserving 25% of North America natural gas. It's a huge play on natural gas, smaller play on the oil liquid pipeline, and then they also have a small utility business which doesn't count for much in terms of operation. So what you see on this graph right there is the natural gas pipeline in blue, the oil pipeline in green, and then the little bolt lightning are the power generator. So you can see there's not much there. When you look at their profit, actually you'll see that 75% of the money is being made from natural gas. Small portion, 18% from oil and gas, from the oil pipeline, and then 7% for the utility place. For their utility business, they focus on wind and solar energy, so classic, trendy, renewable trend there. But then again, we're not talking about a superpower in terms of utilities. It is really a pipeline. You know what's great about pipelines is that they act as toll roads. The thing is, there's not that many pipelines, and if you want to move your product from one market to a key market, from your production to a key market, you need to take that toll road. So most of TRP contracts are 10 to 13 years long, and they are take or pay contract, which means that if you use the pipeline, you pay the price on the contract. If you don't use the pipeline, this is the pay part, you will pay a penalty for not using that space on the pipeline. So basically, regardless if you're using or not the distribution network, you will have to pay a fee for your presence on the toll road. And this contributed to a very solid and resilient business model. What you see on this graph is all the catastrophe and all the fluctuation that could happen around the oil and gas market over the past 20 years. And yet the company continues to generate strong cash flow. And the thing is, as long as you can secure your contract with stellar clients, you don't have to worry about what's happening right there. Another good good thing that happens for TRP is the very low price for natural gas. It's not the best thing for the producers, but for someone who's running a pipeline, that's perfect, because when you have cheap natural gas, you will have stronger demand from commercial and industrial clients. So they will actually use that as a key component in their own business model, because their fees will be lower, and as they are able to improve their margin, they're going to produce more and they're going to use more power. So for the pipeline, it's perfect. It just increases volume and it will sustain demand over time, requiring more long-term contract. In terms of growth vector, TRP expect the demand for both natural gas and oil to grow in the next 10 years. So basically their business model is all about supplying for the strong demand, and that as demand for power will increase and demand for energy will increase, well, they will be there to provide it to their clients. Going a little bit deeper, you can see that the strongest growth vector will be natural gas. Obviously, the future of oil is not certain right now. There is a need, and the Canadian oil sand companies actually need pipelines to get their production going and to reach key market. But we have a feeling that this phenomenon could slow down past 2030. There's a lot of talks about not building classic cars and all moving to electric cars, for example, and we want to become greener as a society. So all the talks will probably put a brake on the demand for oil. But at the same time, TRP, remember, it's 75% all about natural gas, and they're growing their utility business through North American power capacity. And they will have a good mix of renewable and natural gas energy there. So wind, solar, natural gas will probably be a good part of their business moving forward. Now, similar to utilities, pipelines will grow their profit through a huge capex. We're talking capital expenditure. So their investment budget for the next few years, we're talking about 37 billions to be spent. Most of it will go to natural gas pipeline. A good part, 13 billions, is in liquid pipelines, and a huge part of that was for the Keystone XL project. We're going to go there in a moment, but basically it's not going to happen. So they may have free cash, or they may decide not to borrow that much, and a few billions, a couple billions for their power and storage project. The way most of it works is that they will deal with regulators to get their pipelines approved and their projects approved. And once it happens, what it means is they will get cheap debt at very low interest rate. They will fund their projects, and they already know which kind of rate they will be able to charge because they're already in talk with regulators. So basically, it's kind of like a short shot business. Regulators will not approve the construction of a new pipeline if it's not a necessity, if the economy doesn't need it. They don't want to have like bunch of pipelines all over the country for nothing. They want to also reduce the amount of spills for risk spills. And for that reason, when a project moves forward, it's almost certain it will generate strong cash flow. Strong cash flow usually means strong dividend growth, and you can tell when you look at TRP dividend history that you just found one of the best one in town. We're talking about 20 years consecutive of dividend increase. For the first 15 years, it's 7% annualized growth rate, which is kind of very, very generous. But it got even better over the past 5 years with an 8 to 10% growth rate. What's going to happen in the future? Well, actually, the company said, you know what, we're going to maintain that rate through 2021. So we still have a place for another good increase this year. But moving forward, we're looking at 5 to 7%, which is fairly good when you consider that you're already getting paid almost 6% in yield already. And then you know that you're not only going to beat the inflation with your dividend payment, but you're going actually to make even more money considering the inflation. At this point, you may think, well, Mike, how could this company can afford such strong dividend growth rate which such high yield. You told us in the past that a high yield is a red flag, and getting close to 6%, there's something the market doesn't get, or there's something I don't get to be able to do that. Let's dig a little bit deeper into the financial statement just to show you how you can calculate the sustainability of that dividend. What you see here is a part of the cash flow statement from their Q3 2020, so the latest quarterly earnings available. And what you see there is the first column is for the present quarter, and the other column in bold showing 5 million in net cash provided by operation is for the first 9 months of the year. What you see there, let's look at the first 9 months. You're going to have a better picture. So they generated 5.1 billion in cash flow. Comparable funds generated from operation at 5.3 billion, and then they have capital spending of 6.7 billion. In other words, if you're looking at the cash payout ratio, it will be negative. It's going to look very awful because they're spending more that they generate each year. So this tells you they're going to get more debts, as I told you before, but then again, they get the debt at a very cheap rate, and then they get sure with the regulators that they have the right to build those pipelines, and they will make a profitable project with it. When you look at the dividend declared, we're talking $2.43 that were paid to shareholders over the past 9 months, times 940 million shares. You get a dividend payment of 2.5 billion for the first 9 months. Sorry, that was difficult to say. So overall, the cash payout ratio is really 50%. And then you can count on the company to borrow the rest of the money for the project. So don't look at the capital spending on this for the dividend sustainability angle. Look at it when you look at their debt. Speaking of which, I am not too concerned about the debt level right now. They still have strong credit rating. 95% of their debt is fixed rate. So basically, they just enjoy the free ride that we have right now. And whenever they make a project, they make sure it is profitable. So at this point, there is no red flags in terms of debt. However, you may say, well, Mike, you painted such a rosy, pinky, unicorn level portrait of TRP. Is there anything that could go wrong with this company? And unfortunately, yes. The first thing I don't really like about TRP is the length of their contract. Right now, we're talking about 10 to 13 years on average, which is not that long if you compare to Enbridge that has like more than 25 years long contract. If you want to know more about Enbridge, I did a video not too long ago about it. Link description below, you'll get it there, and you'll see why Enbridge is my favorite pipeline. But in the meantime, TRP is not that bad, and management is aware of this flaw. And right now, what they do is that in their 37 billion capital projects that they have, they will invest most of it in 20-year plus contracts. So they're trying to average it down to make it sure that they have long-term contract to not be showing a volatile business model, which is kind of like. The second thing I don't like too much is the fact that they have to deal with regulators. This is part of the business, but sometimes regulators gets in the way. They may not give you the rate increase that you expect. There's a good example that what's happening right now with Consolidated Edison. This is a utility company in New York State, and the regulators of New York State decided to not go ahead with strong rate increase. Mostly, I guess, because the state has been badly hit by the pandemic last year. They want to give customers a break, and there's always this level of balance that you need to reach as a regulator between letting the utility or the pipeline company making a lot of money and then making sure that customers are able to pay their bills, right? And this lead us to Keystone project. So what you see on this graph is actually the kind of like the Keystone XL shortcut that was supposed to be created. Obviously, lots of money was supposed to fund this project. It's not gonna happen, and they will have now TC Energy will have to rely on their existing pipeline for that. Not very interesting right now. Obviously, it's the blow for the company, but remember one of the first slides I showed you, it's only 18,000, it's only 18% of their profit. The current Keystone pipeline will still be in effect, so this is not lost, but this is the Keystone XL that will be canceled. Keep in mind, Keystone pipeline, it's 20% of Western Canadian oil already. Obviously, there's a lot of oil sand producer that wanted the Keystone XL to be produced, to be on the work, because they need pipelines to travel to move their product, and we'll get there in a moment to tell you which kind of company will benefit from the fact that Keystone XL will not happen. Actually, the answer from the company was obviously they were disappointed, but they said that they would put the project on hold and focus on other projects, so you can think of natural gas pipelines. And when you look at their expected capital expenditure for the next 2 years, basically most of the liquid capex of the 13 billion was to fund Keystone XL. What are they going to do with their money? I don't know. Maybe they're just not going to borrow all that money and just drop their capital expenditure under 30 billion. That's a possibility. They could find other projects, or they could buy back shares. I think that at this point it's a little bit too soon to call for any shots. However, when you look at the market, there was absolutely no impact. Well, I mean, like 1 or 2% is not an impact on the stock price. What you see here is both Enbridge and TC Energy graph. Both of them have actually moved in a similar way. You can see that the market expected this. There was no surprise. Democrats have been known for not wanting the Keystone XL project. So it was a non-event on the stock market. And actually, moving forward, there are a few companies that could benefit from the cancellation of the pipeline. One of them is obviously Enbridge, because Enbridge is already benefiting the oil pipeline from the oil pipeline industry. Their Line 3 and Line 5 pipelines projects are not expected to face this end. They go through hurdles. Obviously, it's not easy negotiation, but right now those projects are moving forward. So it's very encouraging for Enbridge shareholders. And the other part where if you want to make a play on this could be with railroads. Why railroads? Because over $50 a barrel for the oil industry, it makes sense to move their oil with railroads. It's not an ideal scenario. They prefer pipelines, but if they can't use Keystone XL, they might as well sign contracts with Enbridge or use Canadian National Railway and Canadian Pacific to move their products. So those are the companies that should benefit from it over the long run. It hasn't had a big impact on their stock price right now. So basically, you're not going to make a ton of money out of it. I think it is one project. It makes a lot of noise. The overall conclusion I made here is if you're looking at an oil pipeline stock, go with Enbridge. If you're looking more for natural gas, go with TC Energy. Both of them offer a generous yield, and both of them are offering a strong dividend growth perspective. The dividend is safe. It will continue to increase mid-single digits for several years. So in both cases, you're making a winner. I would not buy both of them in my portfolio because I'm not a fan of the energy sector. I do have shares of Enbridge. I'm going to keep it that way. I think it's more than enough. If you want to have more on my views on what's going to happen in 2021, I would like to invite you to watch my webinar. I've done a webinar on January 4th. Over 2,000 investors saw it. Link is right there in the link description. You're going to get my views on each single sector. So we're talking about 1 hour discussing sectors from basic materials to financial services and tech stocks. And finally, you will get my buying process inside that webinar too. At the end, I stick around for like an hour to answer all kind of questions, so you get a lot of value out of it. So there you go. It's completely free. If you register, you're going to watch the replay right away. Then again, the link is over there. And until the next video, stay invested.